And welcome to another Leumi Financial Corner. With us once again, Michael Zaremsky, Head of U.S. Private Banking for Bank Leumi USA. Michael, good to speak with you again.
Thanks for having me, Zev. Appreciate it.
Thank you. You know, we've been talking about how we're a month and a half into the whole new year and things are moving along well financially, economically, and we mentioned technology and the changes that it's made. But as we look ahead, what other indications do you see for financial growth? And this is what you do. You help advise people as far as investments are concerned. What do you see as the future?
So I think there's two elements. We've touched a lot about some of the paradigm shifts in innovation and technology, which you mentioned. But I think that there's another paradigm shift that we have seen, which is the concept of what people are doing to invest for income. So typically, asset allocation models or retirement planning have been built on a concept of, live off the income, hold on to the corpus. And a lot of that was really driven by the fact that in the bond market, it was generally speaking pretty easy to make a 5% return without really taking much risk. But in the last decade or so, again, with the Fed continuing to drive interest rates down and sustainable interest rates, kind of under 2%, with negative interest rates in Europe, and the ongoing insatiable demand for new bond issuance, it's been very difficult for investors to create enough income to kind of generate that 5% return that they've been generally accustomed to trying to live off of. So we're seeing a major shift in terms of how people need to rethink asset allocations around income investing, and I'd like to really spend some time and delve into some details on that.
Sure, let's do that. Let's look at what we should be doing.
Yeah, so again, typically investors have focused on fixed income, pure, safe fixed income securities. And again, Zev, you and many in the audience are old enough to remember a point in time where, treasuries were yielding, double digits back in the 70s or early 80s. And, again, typically they've been much higher than they are now. And the challenge now is, where do you go to find yield? And typically when you think about yield and risk are two sides of the same sword. No one's going to give you free yield. Yield comes with a risk associated with it. Typically, in order to find yield, people have focused on credit. So again, moving out from treasuries into corporates, single A, down into high yield, or taking on some type of municipal credit risk. And then people have also really focused on duration, so taking longer bets in the bond market. So instead of a 2-year, 3-year, 5-year note, people stretching out longer. And that's something that's been going on for quite some time. And again, I think we're hitting a point now where credit spreads are, near all-time tights. So again, the amount of compensation that you're getting to take credit risk is fairly limited. So if you look at, different credit ranges, in order to get anywhere near a 5% yield, you have to be out 10 years on duration or maturity, and then you have to be, into double B rated or lower quality bonds. And that's not exactly a safe place to be. So when you look at single A paper, typically, 30 to 65 basis points of additional yield over treasuries, again, you're not really getting compensated for taking risk. So when we think about how we build asset allocation models today, we're looking for other options away from credit or duration. And typically there's 3 things that we're looking to do. In some cases, it's built around structure. In some cases, it's built around the concept of using equity dividends. And I'll touch upon both of those to explain what I'm talking about.
So go ahead. So let's look at that.
Yeah, so a lot of companies, again, typically blue chip companies, strong companies, healthy companies, companies that are producing a lot of free cash flow, they can do a couple of different things with their cash flow. In some cases, they'll make further investments in their business. In some cases, they might repurchase shares, and in some cases, they'll provide dividends. And typically, all 3 of those are a healthy mix, but what we're seeing more and more as companies are awash with cash, and as the Fed continues to keep rates very stable, companies are looking at, giving out dividends and returning to shareholders dividends as a way of paying them back for taking risk. What's interesting right now is if you look at the S&P 500, the average dividend for the S&P 500 is somewhere around 2%. If you look at the typical bond index, which is the Bloomberg Barclays Aggregate Bond Index, the yield is around 2%. So essentially, you're getting just about the same average dividend in the S&P 500 as you are in the broad bond market. And with the S&P 500, at least you're getting upside. There are about 40 companies or so in the S&P 500 right now that are producing dividend yields of over 4%, which again is pretty heady. And again, if you think about the health of a company that's able to put out that type of a yield, it's generally that much of a dividend. It's generally a much healthier company than a high yield company that would be producing that type of fixed income yield. And what I think is also pretty interesting is the dynamic in the United States market, the S&P 500, of what a dividend-paying company looks like. Historically, dividend-paying companies were REITs, MLPs, utilities, companies that typically are very interest rate sensitive because of the high yields that they pay out. But what we have seen now, again, based on a lot of the strength of the economy, strength of the companies, and again, limitations to maybe what some of the investment opportunities are, you're seeing a change in terms of many companies in the S&P 500 now, many more, are paying dividends and are paying healthy dividends. If you look at many of the top tech companies, as an example, companies like Microsoft, Apple, IBM, Qualcomm, Cisco, Oracle, these companies are all paying dividends. So again, you have some equity upside to go along with the dividend as a way of really enhancing the yield pattern. And I think also what's important is about 30% of return for equities have been generated by dividends, over the last several decades. So again, it gives you a nice baseline as a starting point, and again, the yield that you're getting or the dividend yield you're getting is very similar to the yield that you're potentially getting in bond market.
So what it sounds like is today you have to be more on top of things than you did in years past.
Yeah, I think that the categorizations of how we think about fixed income and equity are not what they used to be. And that also leads me into kind of the next part of the conversation, which I want to talk about, which was, other structures or optionality in terms of ways of finding yield. So if you think about alternative investments, some of the interesting ways that you can find securities that are maybe neither fixed income nor equity, but kind of reside somewhere in between. There's a lot of structured notes out there, which are basically a bond issuance with an element of a derivative structure on top of it, and these enhancements are ways and options for you to enhance yield. There's also steepeners, which is in the fixed income market, which was basically a interest rate swap on top of a security, which again allows you another alternative to take advantage of structures in the marketplace which can enhance yield. So I think that you have to look a little bit broader and deeper at the toolbox of opportunities in terms of finding a way to try to attain the yield that you want to attain for your investment portfolio. So again, it's just not as simple as it maybe used to be of saying bonds on the one side, equity on the other side. I think it's a question of looking at certain elements of your portfolio for growth and looking at certain other elements of your portfolio for income, and not necessarily worrying about the labels or the tags that are associated with them, because there's a lot of crossover securities that can help provide both.
Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, thank you for your insights. We look forward to speaking with you in our next installment of Leumi Financial Report.
Thank you very much, Zev. Appreciate the time.
And we're going to be right back. Don't go away. Stay tuned.